Markets are often imagined as omniscient prediction machines, instantly pricing in every known risk. That is a comforting illusion. The truth is uglier. Financial markets operate with a physical lag. The body of the economy can be rotting for months, even years, before the price screen notices the decay. A building stands empty. A mall turns into a concrete skeleton. An entire city built on debt sits silent, and yet the bonds, the stocks, the derivatives tied to those physical assets keep trading as if nothing is wrong. These are the hidden financial ghost towns. They are not the consequence of a crash. They are the early warning system screaming into a void that refuses to listen until the margin call hits. The first corpse is standing in the center of every major financial hub, the zombie office tower. In cities like San Francisco and London, vacancy rates have blown past 30%, a level that should have triggered a banking crisis already. But the loans on these buildings are not marked to reality, they are marked to a fantasy. Banks and private equity funds are engaged in a practice known as extend and pretend, rolling over debt maturities and injecting small doses of fresh capital to avoid recognizing the loss. The physical world already knows the truth. The building generates no income, the elevator shafts are silent, the retail on the ground floor is shuttered, yet on a spreadsheet somewhere, it is still a performing asset. This is a structural trap operating perfectly, designed to delay the implosion until the can is kicked far enough to land on someone else's balance sheet. When that mark-to-fiction game finally snaps, the regional banking backbone that holds these loans will crack with it. Then there is the dead mall, the canary in the coal mine for the disappearance of the middle class. These structures were never just shopping centers. They were the physical manifestation of a post-war economic bargain, that wages would rise, that consumption would grow, and that credit would fill any gaps in between. That bargain has been shredded. The malls are now hollow, their anchor stores replaced by liquidation outlets and haunted by the ghost of foot traffic that never returned. The value of the real estate has cratered, but the municipal bonds and commercial mortgage-backed securities tied to them are still floating inside pension funds and insurance portfolios, priced at levels that assume a revival that will never come. The consumer class that once powered these cathedrals of consumption has been squeezed out by stagnant wages and inflated living costs, leaving behind a physical scar that the financial system hasn't yet acknowledged. Finally, there is the speculative ghost town, the city built not on demand, but on debt. In certain corners of Asia, entire districts of luxury high-rises stand empty, their glass facades reflecting nothing but more empty towers. These are not accidents of poor planning. They are the residue of a credit-fueled development frenzy, where local governments partnered with property giants to build for an imagined future population. The financing was layered through shadow banking vehicles and wealth management products sold to retail investors who were told they were buying into a real estate miracle. The physical reality, zero occupancy, zero rental income, is already here, but the financial product tied to it continues to pay out, at least for now, thanks to a Ponzi-like structure of new debt recycling into old obligations. When the music stops, the loss will be transferred to the very households that were promised safety. The unifying mechanism across all three ghost towns is the same. Value extraction was pulled forward, fees were booked, commissions were earned, and the long-term risk was silently offloaded onto the public. The developers, the bank syndicators, the private equity sponsors all cashed out before the physical decay became undeniable. The structures they left behind are not just empty, they are contaminated liabilities, too expensive to demolish and too broken to sell. The market hasn't crashed yet because the lag effect allows the narrative of recovery to persist long after the biological death of the asset. But the concrete doesn't lie. The silent elevator shafts, the weed-cracked parking lots, the dark towers scraping the sky without a single light on, these are the actual price signals. They are telling you with perfect clarity what the next balance sheet reckoning will look like. The The system isn't broken. It is simply waiting for the lag to catch up to the truth that is already standing right in front of you.